Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
9 out of 10 people are invested in their employer's default pension strategy. However, the hands-off approach might not suit your personal circumstances, goals, or risk appetite.
I want to know what to consider before switching pension. And in today's dumb question of the week, is it worth filling gaps in your national insurance record? All right, let's get into it. So as you said in the intro there, most people, 9 out of 10 people, just stick to whatever the default pension option is that their employer puts them into. And they're shoveling money into that every month, building up, hopefully, a sizable nest egg, without really perhaps understanding what it's invested in and why, and what the outcome of that is going to be. It seems a little odd that we're all hanging our financial future on something we're just trusting other people to get right for us.
I always assumed that there'd be some geniuses running it and that they'd do the right thing. I kind of just trusted people at the companies I worked at, which perhaps in retrospect was a mistake.
I think the people running the pension schemes, as in the people from the company on the pensions committee, are doing their best. But fundamentally, it's a very difficult job to decide what the default option should be, because there needs to be one. By law, there has to be one. And it's got to be a one-size-fits-all for people with vastly different risk appetites in different circumstances. Generally, it's going to have some sort of lifestyling, so it will have more equity when you're younger and less when you're approaching retirement. But still, it's impossible to really fit everyone with that single approach.
Well, I found it really difficult to understand. When I first started looking at pensions when I was in my 20s, I just looked at them and I thought, well, what is an emerging market? I didn't really understand what they were. And what does this mean about adventurous and cautious? It just made no sense to me. So I think I wasn't at a level of understanding where I could look at the descriptions and figure out what was going on. Maybe they should do a better job of educating people.
But you know how hard it is to teach people about investments now, Roman.
Yeah.
And there's this thing, isn't it? Like markets are complicated and you need to simplify it to some degree. But when you just boil it all down to, single words like adventurous or cautious, it doesn't really tell you anything.
And I think there's, to some extent, an onus on people to try and work it out for themselves. I mean, if they're listening to this podcast, they'll be very clued up anyway.
Of course they will. Amazing what you get for free these days.
But seriously, to listen to a podcast about investing, effectively, you're there already. Just the act of listening to this podcast means that you're self-selected.
Well, I wonder if we're talking to the wrong audience then, if we're talking about the default pension strategy. Like, probably most people listening to this aren't, or maybe they're coming to it for the first time and someone has kindly sent them this episode and said, look, this is what you should listen to understand. So let's pretend we're talking to those people.
I know someone who's done that. They actually said, I heard about you because my cycling buddy told me about you and they suggested I should listen to your podcast.
The chats people have in Lycra these days. So let's go back to these default strategies. They do vary a bit depending on the company and the pension scheme. But what are some of the problems or issues people might have with them? Or how might they be investing in a way that wouldn't be optimal?
I think the first one is the level of risk, and that's the biggest lever, the most important discriminant of success and failure in investing, where if you are early in life, then it makes sense to have a lot of equity and learn to love volatility, because volatility is really your friend. If there is a crash, it's going to help you immensely because you'll be buying things at depressed prices and that'll boost your long-term return. So ideally, what you'd have is a lot of crashes early on in your investment career, and then things would quieten down towards the end. But if you're designing a pension scheme where you have to write a letter to your scheme members explaining what's happened over the last year, and if there is a downturn, then explaining that they've made a very significant loss is not going to be an easy explanation. Because they'll say something like, but it's your job to avoid these crashes, not realizing that that's impossible.
That's the danger of having people invested before they really understand what comes along with investing, and the fact that drawdowns are normal, to be expected, and potentially beneficial if they're early on in your investing career. I guess we should clarify that we're talking about what's called defined contribution pensions here, where you're putting money into a pot for yourself and you, as a worker, as an employee, as a saver, are taking the risk. The company is not taking the risk, which is very different from the defined benefit pensions, which maybe previous generations benefited from. So the onus is on you to make sure the investment strategy fits your goals and circumstances. So you mentioned risk and how that often goes along with return, and you're trying to balance those two things. And generally, earlier on in life, you want to take more risk and therefore have more stocks compared to other assets like bonds. There's some research by the Pensions Policy Institute, which looked at, in the default pension strategies at UK companies, what is the asset allocation? And it looks like early on, when you're a long way from retirement, schemes typically allocate around 70% of the assets to equities, to stocks, and most of the rest to cash and bonds. But as you approach retirement age, obviously this changes and they dial down the risk, which is a standard approach. There's now a debate about whether it's a good approach, but it is standard. But maybe they dial the risk down too much, such that when you reach retirement age, only around 21% on average is in stocks, with almost 80% in cash and bonds. That is a massive risk-off move. And I think some of it is because the traditional approach in the UK would have been to buy an annuity at retirement when you don't want volatility, when you're about to hand that money over to an insurance company. But a lot of people now don't buy an annuity, and you're going to stay invested for your whole life. So by going down to just 20% stocks, you really are going to hurt your long-term returns.
So just to remind people why we have these glide paths, as they're called, where you de-risk as you reach retirement age, it's because if there is a crash early on in retirement, you get this thing called sequencing risk, which has a much bigger impact early on than it does later on, because effectively that money's not compounding for a long period of time. Now, there's a question of when you de-risk and how much. If you imagine that you've got a huge pension and your living expenses are fairly modest, well, you'd only need to de-risk a little bit to have enough to live off for the time it would take stocks to recover. But I don't think that's factored in here. So certainly in some cases, that de-risking happens too soon and it's too extreme. And that will have a drag effect on return. So I think that's one problem.
And what other issues have you seen in these default pension schemes?
Well, in the UK, what I've seen is huge UK overweights. So you see a lot of UK stocks in the portfolio, usually around 30%, sometimes even higher. And that's because people expect that, perhaps. I'm not sure exactly why it is.
And for people coming to this for the first time, we should say that maybe 30% doesn't seem extreme to you, but you've got to compare that to the size of the UK market relative to the world. And it should be more like 4% of your assets if you were being neutral.
Yeah, because the UK market's roughly the size of Nvidia or Apple. It's very small.
And that UK overweight would have hurt your returns, at least in the recent past.
Well, not so recent, decades, I'd say. So I think that's a problem. And people don't realise it's there because they can't see the breakdown by country and they wouldn't know that it was an issue.
I think that's the point, isn't it? Is that some of these things you can justify. Like there are reasons why you might want a domestic overweight. Maybe it matches domestic inflation more. But people should know it's there and know the reasons it's there. It's not explained. And I'm not clear that even the people designing the pension funds really know themselves why they're holding such a massive overweight.
Probably a lot of it is tradition as well. You'd expect 30% equity because that's what people had in the past. Maybe that's why it's kind of persisted.
Obviously, there's political pressure to keep money invested in UK assets.
Recently, more so, both political parties are likely to push institutional investors and pension funds to invest more in the UK as a way of bolstering the UK equity market. And it is unusual. If you look at other countries, the UK has an unusually low allocation to its domestic market. I think the other point is the choice of funds and the fees that they charge. And it's often the case that those fees are relatively high, because what usually happens is management just wants to have some kind of pension solution for their employees. They want something which is simple, cheap to implement, and they just outsource this. And if they do that, it doesn't always guarantee that they're going to end up with low-fee funds. And also the choice of funds is usually quite limited. So I think this plan to allow people to have a pension for life where the employer simply pays into their SIP, and if they move job, then the SIP goes with them. I think that's a much better scheme because you get all the benefits of employer contributions and you can shop around for a platform which has got a low fee and you've got more control over what you invest in.
It's really an anachronism that our pension arrangements are tied to our employer. It comes from that era where you'd basically work for one company for your whole career. You'd go down the steel works at 20, talk to your dad's mate, get a job, and then you'll be running the company, right, when you're 60. And so it made sense that the pension would be tied to one employer and they could manage it for you. But now people move jobs all the time, right? You'll probably have dozens of employers throughout your life, maybe more than one at the same time. So I kind of agree that breaking that link between employer and pension, or at least weakening it, might be a good idea. So long as for the people who genuinely have no interest in pensions, they still get a reasonable deal. Like the default option has to exist for them.
And of course, if you have control over what you invest in, if you've got certain beliefs about ESG, for example, then you can ensure that the funds in which you invest are in alignment with your beliefs.
In companies where I've worked before, whenever there was discussion of pensions, interestingly, ESG was the one thing that was discussed in a lot of depth. I think because employers have to show they care about these things, and employees have probably heard a lot of chatter in the media about sustainable, ethical investment. And so I've gone to pensions meetings before, because I'm a nerd, where I'd say like 70, 80% of the discussion was about the nuances of the ESG investment, rather than these big questions about what's our asset allocation, what's the glide path, what are the fees, which are going to make all the difference to your long-term returns. This ESG thing is a bit of a red herring. It sounds horrible to say that, right? It sounds like we're dismissing environmental concerns, which we're not. It's just we've discussed in the past about how this ESG idea is probably not the way to solve it and disguises a lot of greenwashing under the surface.
I'd like to have a whole episode about the book festivals and the fact that some of the large fund managers had to pull out of funding them altogether.
Yeah, Bailey Gifford.
I thought that was pretty shocking. Yeah.
Which ironically is one of the greenest, if you want to put it that way, investment managers. I think only 2% of their funds are invested in any kind of fossil fuel companies.
Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and the lowest FX fees I could find on the market. Looking to keep things simple, you can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. If you trade US stocks, then 24/5 trading gives you non-stop market access from Monday until Friday via more trading sessions, while still using Trading 212's fractional shares and zero commission trading. You can also switch between 24/5 and regular hours orders at any time. Customers can also benefit from the Trading 212 card, which offers 1.5% cash back on all transactions until October the 1st, 2024. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1 and use the promo code RAMIN, RAMIN, within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than you invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You're responsible for all investment and rebalancing decisions. Free shares can be fractional. Terms and fees apply.
So if you're listening to this and you think, oh, well, maybe I should really look into what my pension is invested in, and you take the time to go in and look at what's in your default fund, and you think, you know what, maybe this isn't quite right for me. Maybe it's not taking enough risk. Maybe it's taking too much risk. Whatever it might be, you decide you want to take a more hands-on approach. You've kind of got two options from there. One option is within your employer scheme, your workplace pension, you can go for a DIY option and choose your own funds, though there are limitations to that because they might not offer all the different funds you may want to choose. Or you can set up your own pension, a SIP, self-invested personal pension, and transfer your money there. Let's talk about the option of keeping it in your workplace pension first. What should people be looking for when they're looking down the list of funds they may want to allocate to?
Well, like we said, the most important thing is the percentage of stocks and bonds in the portfolio. Now, you'll probably see that it's going to give you a breakdown. Usually they have pie charts which show you this. If you're young, in other words, more than 10 years from retirement, then having a very high equity allocation probably makes sense if you're willing to ride the roller coaster of equity. If you're someone with a cautious disposition, then that may not be appropriate for you and you'd have to dial down the equity. But generally, that age-related rule is a good one. Now, this asset allocation choice sounds dry, but it makes a massive difference over the long term. And that's because, on average, bonds underperform stocks by around 4% per year. So if we look back over a century, in the UK, for example, stocks have returned 9.1%. If you subtract the effect of inflation, that goes down to 5.3%, whereas bonds have returned 5.1%, which falls to 1.4% if you subtract the effect of inflation.
This is the annual rate of return that you get over the long term.
Yeah.
Obviously, in any one year, it's going to be way above or way below that.
Yeah, it fluctuates massively, but those are the averages. And over a long period of time, what you earn is roughly the average. So a 4% annual underperformance makes an incredible difference, and it could destroy a lot of wealth for you if you're too cautious.
But the point is, with stocks, it's going to be a wild ride. You have to expect that. There's going to be crashes where you lose 40, maybe 50% of the value of your investments. If the future's anything like the past, they'll recover and you'll go on to earn this average rate of return. But to invest in stocks, you've got to get comfortable with loss.
And not knowing about it is actually a superpower. If you don't really monitor it, you could actually do pretty well once you've chosen to go down the stock route. Another good thing is that while you're still saving, if there is a fall in equity markets, all that really happens is you buy at a lower price. And that means it boosts your long-term return. So you should really be hoping for crashes early on, because that's really going to help you. If you're really unlucky, you could start your investment career when markets are very elevated and expensive and there hasn't been a crash for a while. And then towards the end of your career, the crashes start happening.
But still, you don't choose when you're living and you have to invest whenever you are. And usually, stocks are going to beat bonds in the long term.
Yeah, and the averages are all you can really go by.
But you still have to choose a specific fund to go in your pension, or multiple funds. How do you discriminate between them? Now, obviously, this could be a whole episode in itself, but just in very high-level terms.
So I'd look down the list and I'd say, well, is there one which has the right amount of stocks and bonds in it? If the answer is yes, I'd then look at the fee. What's the annual fee that it's charging? If it's more than about 0.2%, then that's probably too much. And the amount that they charge will probably come down over time. So if we were to do this episode in 10 years' time, I expect I'd say something like 0.1%. But that's what I'd look at. That's the second thing I'd look at. And then within the actual allocation, what kind of stocks do they invest in? Is it a growth tilt? Is it value tilt? Have they tilted in some way? Is there a UK overweight? I.e., is the UK weighting more than 4%? And if so, why? And also, is it actively or passively managed? In other words, are they trying to beat the market or simply track the market? And that will be reflected in the fee as well.
And you might think, if you've not really experienced this stuff before, that, I want one that's trying to beat the market. I want to do really well. But weirdly, in investing, typically tracking the market will beat the vast majority of people who are actively managing their funds.
Yes, it's a shocking fact that the fund management industry fails so often, but it's simply what has happened.
And you can get lower fees for going with a passive fund. But the challenge I think a lot of people will face when they come to build their own portfolio within a workplace pension is that your options tend to be quite limited. Maybe there won't be a fund which is perfectly in line with what you would ideally like.
And this is why some people set up a SIP. And what they can sometimes do, and this is something you have to ask your HR department, is every year they take the accumulated money for the previous year in their workplace pension and they transfer it out into their SIP. and then they can choose whatever they want. In terms of funds, they have a much wider choice. The fees are usually low, make sure that's the case. And that's much more flexible from their point of view.
And that's called a partial transfer. And that's not always possible, because what you don't want to do is shut down your workplace pension completely and then stop getting employer contributions paid into there.
That would be insane, because one of the incredible things about working is that you get contributions to your workplace pension.
Yeah, that is free money, effectively. So make sure you don't lose it. But most schemes, I think, will allow partial transfers if you want to do that. But there are certainly some things you want to think about before you commit to moving money out of your workplace pension. Obviously, like you say, on the face of it, are the fees going to be lower? Have you got better choice of funds? All that stuff. You can shop around platforms to find one that fits you. But also check that you're not going to lose any benefits or rewards that are valuable to you, which your workplace pension might provide.
Now, sometimes we go through an employer's actual funds which are on offer, and I'll be talking to a client and they'll show me on the company's website what they've got. And we'll look up the fees on another platform, and the fees will be something like, I don't know, 0.4%. And I'll say, oh, this is looking expensive. But then they'll say, oh, no, because on our platform, this is subsidized. So they get a reduction. And if they move to another platform, they're going to lose that subsidized fee. So that's something to check.
Yeah, both for the funds themselves and also the scheme management fee, however you want to call it, the platform fee. Some employers will just pay that out of pocket. And therefore, it's obviously going to be cheaper to stay there than it is to go somewhere else where you're going to be paying for it, probably.
And normally that's what you'd see in a large company, because they have much more buying power and much more clout when it comes to the fund managers and the platforms.
The other thing is that some schemes have a loyalty bonus. I think it's quite rare now, but pension providers obviously want your cash and they want it for the long term. And so there are sometimes incentives built in to stick with your current provider. So check for that.
And there could be things like life insurance built into the pension, and that could be quite valuable. Or alternatively, there could be guaranteed death benefits. So you can always check with your HR department whether that's the case before you make the leap into another platform.
And whether it's the case that doing a partial transfer loses you those benefits, or what percentage of those benefits you lose. But the big one, which is going to affect actually quite a lot of people, is a concept called protected retirement age. Now, we know that in the UK, the age at which you can access your pension has been steadily increasing. And it will rise from 55 to age 57 in 2028. However, there's this concept of the protected retirement age, whereby if you meet certain criteria, you're still allowed to withdraw at age 55. So, you can get your hands on the money 2 years earlier. And generally that depends on having been a member of the scheme before a certain date. So by transferring, you might lose this protected retirement age. So it's definitely something worth checking. Maybe it makes no difference to you, but maybe it does.
Again, something that used to exist, which is much less common now, would be a guaranteed annuity rate. So that means that with your pension pot, after you retire, you buy a fixed income. Often it's going to be inflation linked, and you get a guaranteed annuity rate that goes with the annuity that you buy.
Yeah, those kind of things could be valuable if the annuity rate was somehow set at a crazily high level. Like they did negotiate a great deal a decade ago, and it's in the fine print of your pension. They might not be that keen to tell you about it if it's a really good rate. Because then the pension provider might not want to commit to that annuity rate anymore. But annuities have become much less popular over time. Most people are looking at this kind of flexible drawdown approach where they take the money as and when they need it out of the pot themselves, rather than buying a guaranteed stream of cash for the rest of their life.
I think, understandably, it is more flexible, but there is a lot more volatility and fear that goes with it. And there is a risk of shortfall if markets crash during the course of your retirement.
I mean, the primary reason I think why annuities became less popular was because interest rates are low, and so therefore the money that an insurance company would offer you for an annuity, as in how much would they give you every year, seemed so low. But now rates are back up at 5%. Annuity rates have gone up. Maybe they'll become popular again. Who knows?
And I think that comfort of mind certainly suits some people, particularly if you're very risk averse. Having someone else take the risk and not having to worry about whether you'd have a shortfall is certainly worth it for some people. And you don't have to do it with the whole pot anyway. You can just do it with a proportion of the pot to cover the basics and then keep stocks for the upside. And I think that's another reason why people have stocks in their retirement portfolio, because potentially you could be lucky and have a huge return in retirement years.
But the ability to buy an annuity shouldn't be affected by what scheme you're in. You can go and buy it on the open market. It's just worth checking if there is this kind of guaranteed annuity rate in your workplace scheme. It's unlikely these days, but you never know. There are a couple more things to be aware of before you push the button and switch out of your workplace pension. The first one is exit fees. As we've said, pension providers want to keep your money. They earn a percentage fee on that every year. And so they're obviously incentivized to do things to stop people moving. And one of the things I hate is an exit fee, saying if you want to go out the door, well, we're going to tax you.
Yeah, it's atrocious. And the FCA is really negative about it, the Financial Conduct Authority, and they're trying to clamp down on exit fees. And that's a good thing. It was too long coming.
But they might still exist.
Yeah, if you've got a legacy pension scheme, maybe it's still there. So that's definitely worth checking. You don't want to lose wealth because of moving the money out.
And if there is an exit fee there, you're going to have to weigh up, well, the cost of paying that exit fee, am I going to be able to earn that back and more by being in, I guess, a lower fee scheme somewhere else?
And I think at this point, it's probably worth mentioning that your company's policy when it comes to its pensions isn't set in stone. Often there's a pension committee at the workplace which has got members of the actual staff on the committee in order to represent the voice of the staff. So if you can find that committee, just say to them, look, this is crazy. We're not allowed to transfer out our pensions. We've got this exit fee with the existing one. The restriction of choice is terrible. The fees are high. Whatever the reason, you can feed that back to the committee.
Yeah, or just go and get on the committee yourself. Hostile takeover. Switch the company's pension scheme and then take the heat when the market crashes. But that's the point. I think we shouldn't be negative on people who are actually trying to get in there and manage the pensions, because most people in the workplace don't care about their pensions, and someone needs to take the responsibility for doing it. And as we said right at the start, coming up with a default option which suits the most amount of people possible is so difficult. But things like exit fees are obviously not to the benefit of anyone, so they can go in the bin. And of course, maybe you're working in multiple places, especially over the course of your career, and you've got lots of different pensions, lots of little pensions, and you're thinking, should I consolidate them into one big manageable pension, right? This is always the thing. Shall I consolidate my pensions? And I guess from a simplicity point of view, it makes a lot of sense. However, there is something worth considering, which is that there's kind of a loophole in UK pensions law called the small pots lump sum.
So the threshold for small is the value of the pension has to be £10,000 or less. And according to the government, you can take any pension worth up to 10k in one go. It's called a small pot lump sum. And if you take that option, 25% of it is tax-free. And there is a restriction on the number of them which you can take out.
Yep. So up to 3 small pot lump sums from different personal pensions. But apparently from workplace pensions, there is no limit. So if you've worked for 12 employers and you got like £2,000 in each of these pension schemes, go nuts. And one of the advantages of doing this is that money taken as a small pot lump sum does not use up your lump sum allowance under legislation. But the rules on this are changing, as is the lump sum allowance all the time. So it's worth looking into if this is something you want to do.
The last thing to consider when you are thinking about moving your pension to another provider and consolidating is how long it's going to take. And there is huge variation in the time taken.
There was a study by Origo which showed that the average time it took to transfer a pension was just 14 days in 2023. So that doesn't seem too long. What is it you're concerned about? The time out of the market? Like if the market suddenly rallies and you miss out on that because your pension's been turned into cash to give it to another provider?
Yeah, that is one concern. Although what you could do is just delay the sale until the very last minute. And then the minute you get into the new scheme, you buy whatever you had previously immediately. But I think those average times cover the fact that it often takes much longer. I consolidated 3 of my pensions onto one platform, and one of the transfers took 3 months, one took 8 months, one took 9 months, and it ended up as a bun fight about the ICO numbers of the platform I was moving on to. So it was just incredibly painful. But I'm glad I did it, because now I've got control of the money and I can invest in anything I want, and the fees are very low.
You'll be pleased to know, Romin, that the cap in legislation for the time it takes is 6 months. So 2 of your pension providers breached that cap.
Maybe it was my fault. Maybe I was slow in coming back to the questions they asked, but it did seem to be a lot of paperwork. But of course, you want there to be a lot of paperwork and obstacles. Otherwise, people could do things like transfer to an inappropriate platform or to a fake platform. It could be a really bad choice.
Yeah, that's the point. This is a big thing to do, especially if there's loads of money in one pension scheme. To move that is a big decision. And we should make the distinction as well between a defined contribution scheme, which is the things we've been talking about here, and a defined benefit scheme, which is going to pay you some kind of guaranteed income in your retirement. And I believe to transfer a defined benefit scheme, you need to take official financial advice and prove that you understand what you're giving up. Because it's really hard to compare the benefits of a DB scheme and a DC scheme. The risk is just entirely different.
Yeah, you need financial advice to do that. So the consolidation I did was all DC pensions.
And to me, it makes sense to move your pensions to somewhere you're happy with, so long as you're not giving up too much in the way of benefits from your workplace pension. Once you start getting into investing, it doesn't take too long before you realize, oh, this is what I want. I believe this about investments and markets, and I want it reflected in my own portfolio. And it can be so frustrating logging into your workplace pension and going, oh, I'm going to have a UK overweight. It's going to have to be actively managed to some degree. It's just so annoying. So if you're in that position, I can see why a lot of people look into moving.
And you're not powerless, because ultimately it is your money. And the company you work for should at least have some interest in ensuring you get a good outcome.
I think workplace schemes could be improved so much in terms of communication. Like I remember getting these kind of pension packs and annual statements where they project what you're going to get in retirement. And it looks like so disappointingly low. And you're like, how have they come to this figure? And it's when you look at the assumptions, it's based on extremely cautious rates of return that I think it kind of puts people off pension saving, because they look at it and go, well, it's not going to make much difference to my life, which is the opposite of the truth.
And I have to work until I die. Yeah.
Maybe that's why. Maybe that's the conspiracy. People don't quit. But when you start building your own pension, if you go down that route, I think one of the key things is not to see your pension in isolation. And like, that's my money for retirement. Everything else, all my other assets and income and investments are something different. You really should view it all in the round, even though pensions have this date which restricts when you can access them.
Yeah, for example, if you do have something like a buy-to-let property, that acts very much in a bond-like way. So that should affect your overall asset allocation, and you can take more risk with the rest of the portfolio if you do have sources of income which are reliable. Maybe you have got defined benefit pensions, in which case those are very safe because you're not taking any market risk there, if they are inflation linked, say.
And your state pension is kind of like an inflation linked annuity.
Assuming that carries on existing, of course.
Let's hope, right?
Now, people in the community at PensionCraft told each other about the ability to transfer out their pensions into their SIPPs, how to do it, the process involved, and the potential pitfalls. And that's just one example of the benefits of being part of our community. So if you're interested in joining us, just go to our website, PensionCraft.com.
Okay, today's dumb question of the week. Is it worth filling gaps in your national insurance record? So in the UK, the value of the state pension you receive in retirement is determined by how many years you've paid in national insurance. I believe you have to have made a minimum of 10 years of payments to get any pension, and I think 35 years to get the full state pension. But you might have taken time out of the workplace along the way. Maybe you had kids, maybe you went on a big long holiday. And so you can log in on the government portal and see, oh, in 2019, I did not meet the minimum threshold of national insurance payments. And there is an option to pay hand the government some money to fill in the gap.
Unless it was a long time in the past, of course, which is what happened to me. So I'm going to be working for 2 more years before I complete my NI contributions, my 35 years.
But there's a clear trade-off to be made here. Is it worth me handing over that money to the government? How do we know?
There are some assumptions you have to make about how long you're going to live once you start getting the state pension. But there is a break even. And for most people, it is certainly worth considering paying the money up front. I think part of the attraction is the fact that it isn't market linked. So you get that income regardless of whether markets crash or whether they don't. And now that we don't have defined benefit pensions any longer, or they're very rare, that is an attractive prospect.
The break-even period, as you described it, is probably quite short. So there's an article on the consumer website, Which, titled, "Should I Top Up My State Pension?" And they look into this break-even idea. And they reckon it's around 2.5 to 3 years for employees to break even. So you need to pay something like £800 to £900 to buy back an extra year. And then you're going to get just over £300 a year extra in additional state pension. So it's not a bad deal, is it, on the face of it?
Yep, if you're healthy and you're sure you're going to make it, then why not? It's certainly worth considering. 2.5 to 3 years. Most of us are going to make it past that point, I hope.
Now, if we were going to do this properly, Romin, we need a discounted cash flow model. We need to account for the time value of money. Which hasn't done any of that.
So if you pay money today, it's money that won't be compounding for a long period of time, potentially. So if you are closer to retirement, that compounding effect is smaller. So being close to state pension age means that it probably is worth doing this and buying the missing years.
And also, you probably know how long you're going to be working. When you're young, maybe you don't know. And you might well make those 35 years of contributions anyway without having to buy any top-ups. So I think it's a harder decision when you're younger. And maybe you need the money more as well when you're younger. There's other things you could be spending this on. Deposits, your own personal pension.
Also, there'll be lots more politics between now and when you receive your pension. So who knows what the state of the pension will be 20, 30 years in the future.
Yeah. There are certain scenarios where it's obviously not worth paying to fill the gap. So if you know you are going to get the full level of 35 years of contributions anyway, because you love your job and you're not going to retire for 10 years, then why would you jump the gun and pay to fill the gap now?
When I left full-time employment to set up PensionCraft, one of the things I didn't realise was that I'd have to pay Class 2 contributions. And that way I could ensure that I was making the contributions and not missing years.
But if you are self-employed and don't have to pay Class 2 contributions, either because your profits are really low or you live outside the UK, maybe that's another scenario where it's worth considering paying to fill the gaps.
Now, you really shouldn't underestimate how much the state pension's worth to you. If you were to buy an annuity on the open market, it would cost you a lot of money.
I was trying to work this out, actually. How much would you have to hand over to an insurance company to buy the equivalent of a state pension? It's hard to get an exact figure, but it's hundreds of thousands of pounds it would cost to buy this. Probably something like £300,000. So yeah, it is a big benefit, even if we moan about how little state pension is.
And it makes it so much easier when you're planning for your retirement, knowing that that's going to be there. So that even if your pension pot fails completely, at least you'll have something to live off.
Thank you for joining us for Many Happy Returns. Do send us your questions, no matter how dumb, at the email address mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.